Previously, Cleanmore had to pay its shareholders a dividend because, again, our owners expect that if we're profitable, they should get a portion of that profitability. Well, we invested in another company. We invested in Eddy Electronics. We are part owners of Eddy Electronics. So if that company is profitable, they should be paying us a portion of that profitability. And here on March 31st, we see that Cleanmore received a cash dividend of 60 cents per share from Eddy Electronics for its remaining equity investment in that common stock. They're going to pay us 60 cents per share for every share of their stock that we own. Well, first things first, I think our best course of action is to figure out how many shares of Eddy Electronics do we own. Just like we did with our own common stock, let's go and do this with Eddy Electronics. And what we're looking for are any journal entries that have the term equity investment in it, because they're the only company that we invested in. And right here we have one. We initially purchased 80,000 shares of Eddy Electronics. Did we sell any of those shares, or did we increase our purchase in those shares? Well, let's find out. We had 80,000 as of January 3rd. Scrolling down here a little bit, we see that on March 1st, we sold 10,000 of those shares. And going back through, that is the only two entries we have related to Eddy Electronics common stock. So if we purchased 80,000 originally and we sold 10,000, that means that at this point in time, on March 31st, when Eddy Electronics is paying Cleanmore their dividend, Cleanmore owns 70,000 shares. They're paying us a cash dividend, which means we're the ones getting the cash, so we're going to debit cash this time. And we find the amount by multiplying how many shares we own, which we just determined was 70,000, times the per share dividend rate, which is 60 cents. And 70,000 times 60 cents per share means that we are getting 42 grand from Eddy Electronics for our investment. What are we going to book this as? Well, when we paid, we put it down as cash dividends because that's our withdrawal account. But here, we're not withdrawing money from our own company to give it to it. Somebody else is withdrawing money from their company to give it to us. We're the ones getting the money. This should be increasing our profitability. And it is. It's a dividend, but in this instance, it's not a dividend that we are paying. It's a dividend that someone else is paying us. So for us, it's dividend revenue. So if you are the person receiving the dividend, it gets recorded under dividend revenue. If you're the one paying the dividend, it gets recorded under cash dividends at the time that you declare it. And we received dividend payment from Eddy. Eddy is not our only investment. We are also invested in the bonds of Better Buy Corporation. And right now we're going to receive a quarterly interest payment from Better Buy. The journal entry setup is going to be pretty much exactly the same. We're the ones getting the money. Sorry about that. That should be March 31st. We're the ones getting the money, which means we're going to have to debit cash. It's going to increase our profitability. It's going to count as a revenue, but they're not giving us a dividend. They're paying us interest on the bonds that we own of theirs. So that becomes interest revenue. Now we got to figure out how much, and because it's a bond, we can figure it out using the standard bond interest formula of face times rate times time. So let's scroll back up and find if we have any information that can help us do these calculations in the entry that we put on the books when we purchase these Better Buy corporate bonds. And scrolling back through, looking for an HTM debt investment because that's what we booked it as. There it is. We bought $5,000 worth of these bonds. They are 5% bonds, but 5% is for the year. We're not getting a yearly interest payment. We're getting a quarterly interest payment. So our face times rate times time formula is going to be 500,000 times 5% times 1 quarter. And I can scroll back down to the journal entry we were working on and put that in as our cash. 500,000 times 0.05 times 1 quarter. Oh, put 14 in. Sorry about that. Let me fix that situation. See, professors make mistakes too. Oh my goodness gracious. No, that is not what I want. Let's try that one more time. Equals 500,000 times 0.05 times 1 divided by 4. Comes out to be $6,250. And there is the correctly typed formula up in the formula bar. That is the amount of cash we're receiving, so it's also the amount of interest revenue you should recognize in the journal entry where we recorded the fact that we received an interest payment from Better Buy. Underneath this, there's a bunch of journal entries, we scroll down, that are already filled in. We are a company that manufactures appliances. We're going to have our normal operations during the period. We're going to make inventory. We're going to have to pay for it. We're going to sell that inventory, etc. To save you time, because the bond, stocks, investments portion of this is already long enough, I filled these entries in for you. They'll be filled in on your test as well. All that information is there so you can use it later to make your T accounts and ultimately present those accounts on your financial statements. So we have a bunch of journal entries given to us. The first one is our inventory. Put all our inventory in the books that we created during the period, and we accounted for how we paid for it. Then we have our sales, how much of that we collected in cash, which is how much is still owed to us. That is on our books already. We have, oh my goodness, our COGS, how much expense we get to pay for product costs, how much expense we get to record for product costs, the ones that we've actually sold, that entry's on the books. Underneath that, we have our entry for the purchase of supplies and equipment in cash. And then we have an entry which records all of our operating expenses for the period, so all the non-inventoriable salaries, utilities that we had, our advertising, supplies, property tax, depreciation on machines and buildings that are not used in production, and miscellaneous expense. We've got all of this stuff in here. We also have our income tax that we are paying for the period. That entry is given to us as well. We have one below it, two below it actually, that we still need to fill in. The first is an adjusting entry. And this adjusting entry is going to represent on our books that that investment that we have in Eddy, which is an asset to us, has a certain value. And because we've been recording it at its historical cost of what we paid for it originally way back in the beginning of the quarter, that value that it's on our books for might not be the actual value we can get when we sell it. GAAP allows you for investments that you have the intention that you would sell if the price was right, that you could foreseeably sell within the next quarter. GAAP allows you to make a thing called a fair value adjustment to bring it up to its current market price. And the entry for that is always going to be exactly the same. It is a debit to an account called fair value adjustment. This is an account that is tied to the other account, in this case, and tied to our equity investments, which brings up the value of that investment if the price went up, or brings it down if the price went down. The second account you use is called unrealized holding gain. An unrealized holding gain is an equity account. It is basically saying we could have increased our income by this much money had we sold this investment at a profit, or if we sold it at a loss, this is how much it would have decreased our income. So we have all that in here. Now what we need to do is figure out how much more that stock could be sold for today than what we're carrying it on our books for. So again, we can go back. We're pertaining to Eddy's common stock right here. When we did our calculations previously, if you'll recall, we have 70,000 shares of Eddy stock. 70,000 shares, paid us 60 cents in dividends, how we got the 42 grand. Well, what originally, when we bought these, did we pay for those shares? We paid, when we originally purchased this equity investment in Eddy's, if I can scroll up and find it, there it is, we paid $31.25 per share. So those 70,000 shares that we're holding on to, the 80,000 we purchased less the 10,000 we sold, are being carried at a cost basis of $31.25 per share. But they're worth a whole hell of a lot more than that. If we scroll back down to our entry we're working on, we see that the current market price of those shares is $46.25. So what we do here for our adjustment is we take the amount of shares that we own in that particular company and we multiply it by the difference between what it's currently going for and what we paid for it originally. We originally paid $31.25. It's trading at $46.25. That stock has gone up $15 since we originally purchased it. So if you take, again, shares sold times current market price minus cost basis, we're going to come up with $1,050,000. That is not a small amount. We want our investors to know that had we decided to sell Eddie's stock at the end of the period, we could have increased our income by over $1 million. We also want them to know that the investment we have, that asset, has a valuation way above what we're carrying it on the books for. And that is what these two accounts do. They're going to allow us in our adjusting entry to show on our financial statements what the true valuation of our company is based upon more realistic information of the value of Eddie's stock. So we adjusted the book value of Eddie shares to fair value. That is an adjusting entry. And if you remember the accounting cycle, you need to make your adjustments before you make your financial statements. So we had to have that guy in there first. We have an entry underneath here that says Cleanmore Appliance recorded the closing entry to close its cash dividends. That is the closing entry. So for that one, save it to the end, because closing entry comes after you prepare your income statement, your statement of RE, and your balance sheet.